Hi, this is Scott Callon, Chairman of Ichigo. Thank you very much for joining our FY25 February 2025 first half corporate presentation. I am joined by Ted Fujita to my right, who is our lead independent director. And then on my left is Dan Morisaku, who is a senior member of our finance team and head of global IR for us. So thank you very much for joining. Let's go straight to it. So here's a summary on page 7. All in OP down 32% year on year, cash net income down 43%. So these are not numbers that look fantastically good, and they're fine. So the business is going very, very well. Stock earnings, you can see, are up 11% year on year. We have movements around during the year in terms of when we get our flow earnings, and sales will be accelerating in the second half of the year. So despite the numbers looking light, and they are light, not a problem at all. We launched, or will be launching on October 17th, so 7 days from today, our 5th Ichigo Residence token. That's part of where we have some visibility already on what forward earnings look like in the second half of the year. We have announced a buyback of 6 billion shares, 6 billion shares in terms of the amount, 3.9% of shares outstanding. The background to that is the shares are about as cheap as my memory serves. We're trading at 11 times accounting earnings, about, let's see, what is it, 8.5 times cash earnings. So really, really good value, given how strong our business model is and how productive it is in the current market environment. And going forward, look, this is not about, to build huge value over the long term means you have to build in the short term and medium term and the long term. We are focused on the long term. Things are outstanding. We think it's very good value for us to be buying our shares at these levels. In terms of RE100, we completed our 100% renewable energy transition during the quarter, so things are on track there. In terms of the general outline of where we are, as you know, we run the firm to be structurally profitable. We need stock earnings to be over double fixed expenses. We're running at 270%, so that's very much on track. Sustainable real estate, as you can see, the stock earnings are up 15% year on year. That's mostly contributions from hotels, which are going very, very strong. And both in terms of hotel rental income to us as the owner, and also our Ichigo or 15 Hotels, which is an Ichigo-owned hotel operator, which is doing very, very well. We've got a small decrease in asset management stock earnings year on year. That's because we cut for Ichigo Office asset management fees. For the full year, we expect to be the same as last year. And clean energy is up on us bringing up a large plant online at the end of last year. So we're running right on plan. Here, what the numbers look in terms of breakdown, you don't get to choose the numbers that you like. So even though the accounting numbers look really, really strong, so operating profit, OP up 25% year on year, recurrent profit up 36%. Those are not the right ways to look at us. It is the all-in OP number where we take, and we've done this for a while, so I'm sure you're familiar with this, but we take stuff that shows up because of the fixed asset categorization of certain of our assets as extraordinary gains. We put it back into operating earnings because it doesn't matter if we're classifying these assets as current assets or fixed assets. We're doing all this value add work, and so it's a better way to look at and understand the firm. So as I said earlier, we're going to have flow earnings, so asset sales and the capital gains on them concentrated in the second half. So those numbers are down year on year, 30%, relatively significantly, right? We had a very strong first half last year. We have a lighter one this year, but on the full year, we expect to be up substantially. And again, our cash earnings are substantially higher than our accounting earnings because we focus on cash flows for shareholders. This gives you a little bit of the breakdown, starting on asset management. Ichigo Hotel and the Ichigo Residence tokens are driving growth there. As I already pointed out, we had a fee cut. Ichigo Office REIT, which is good for the Ichigo Office REIT shareholders. So that's a positive. Means we have to kind of work harder and do more as a sponsor of the REIT, and we're fine with that. Stock earnings, again, the hotels are very, very strong. This is an asset that we're involved in very extensively because it is harder to do. So Ichigo's capabilities in this area are important. and it just has a lot of growth to it. There's inbound growth, and there is kind of an opportunity to upgrade Japanese hospitality across the board, which we think is a significant value driver. Flow earnings, again, are going to be primarily in the second half. We already have visibility on one, which is our fifth token sale. I've talked about, and we can touch about it a little later, but we have visibility also on a sixth and seventh token sale for this year, meaning we haven't announced it, but we expect that to happen. So we're comfortable with what we're going to have in terms of full year earnings. We do expect to have record earnings in terms of stock earnings growth. In fact, we at this point expect to beat these numbers. And again, hotels, this gives you a little bit of a breakdown. Hotels are a big driver. It's worth pointing out, as you can see at the very bottom, on the right-hand side, on the left, inside the box, you got the navy blue on the top, and it shows you the breakdown between sustainable real estate, clean energy, asset management, and hotel operator and Propera, which is our asset, our kind of artificial intelligence, AI-driven pricing mechanism for hotels. You can see that for the full year in 24 too, so February to 2024, we only did 784, and this is primarily our hotel operator, 1.5. We did 784 in the first half. We did 851, so we're up very, very substantially. This is a very high quality earning stream. No assets involved. We just manage assets well and get paid for it. Shows what's happening on financing. As you can see, rates have gone up from 0.89%. Our average financing cost has gone up to 1.13%. At some point during this presentation, and hopefully it's okay, I'll make that point right now. We need to talk about what we think is happening. That's a mispricing in our shares and broadly across Japanese real estate. So one of the fantastic elements of Japanese real estate investing is that you finance structurally below your cap rate, unless you are buying assets at a really bad price with really low cap rates, or you finance terribly. So, we finance an average of 1%. We buy assets that typically yield 4 to 5%. We add value to them. It is just a fantastic way to make money. When you're funding at 1% and your assets yield, say 5%, unless something goes horribly, horribly wrong, you win. So what's interesting, though, is our shares have sold off, and the broad real estate market has sold off. Real estate shares have sold off in the last couple months on the basis that the BOJ is raising rates. And yes, this is correctly viewed as a negative, as a headwind for us. So we finance now, 20 plus basis points higher. What's not been part of that conversation, which is absolutely fundamentally far more important, is that the problem with Japanese real estate investing for decades, everyone understands you finance at very low financing rates below cap rates. But the big problem has always been replacement cost doesn't go up. There has been no inflation. And so as an owner of a real estate asset, you want to raise rents, but with replacement costs going up, you have an office building, somebody can build a brand new building next door at the same price that you built it 10 years ago, 20 years ago. You cannot raise rents. And so the most important thing that has happened is the BOJ is raising rates because there's inflation. And to be very clear, construction inflation is much, much higher, like even an order of magnitude higher than generalized inflation. Construction costs were up 50, 60% over the last several years, largely because of a severe labor shortage. It's just got very hard to get kind of the labor you need to put things up. And the result of that is there has been an utter transformation in our ability as real estate owners. We become a normal country in Japan. Every other market, you raise rents year after year. And the reason is because if somebody builds an asset next door to you, they build it at a price that's 20% higher, 10% higher, 30% higher, 50% higher. And that's the market we're finally in. So the most powerful change in Japanese real estate in the last several decades is not that we've got rates that have gone up a tiny bit. We're now funding above 1%. It's that we finally have inflation driving higher replacement costs, driving higher returns organically from our assets over time. That is the powerful driver of the economics of the operating environment for our business, in which we embed a very powerful business model. So you can understand why we're buying back our shares. This shows you what we're doing on acquisitions and sales. They largely kind of flat against each other. We are active in office. It's worth pointing out, and I've said this before, the Japanese office market is radically different than, for example, the US or Europe, which is kind of a dumpster fire. Japanese offices are full. We had Miki Shoji data for September for Tokyo office out today. Came in at vacancy at 4.6%. That's down from 6.1% a year ago. The market is getting tighter. Rents are going up a tiny bit, but it's primarily kind of tightness in the market. Japanese people are coming to work, so that is one element that's driving demand. But more fundamentally, tenants want more space for their workers. And so the office environment is relatively robust. And I think it's become the case, certainly in the last 6 months, that global investors have come to understand that the Japanese office market is robust and is a good place to put money. So the global investors are back in office, and we're very active in the space. The Ichigo Meguro building. I don't know if it's worth pointing out that this building is 300 yards from my home. So every day I walk by it and I see this big kind of, you see on the upper right hand side, you can see the Ichigo sign in Japanese. This is what we do. I'm not buy assets 300 yards from my house. This has never happened before, and it's not an element of our search for assets. But it is a extraordinarily well located building, right near Meguro Station, right on the Meguro River, which is an incredibly famous cherry blossom viewing location. I don't know, do hundreds of thousands of people come there? 1 million people come there every year. I mean, a lot of people come and they look up and see it. And this building is right on the river. Because of the river, you can see it from very far away. And so we point out that I just pointed out that it has kind of high signage visibility for us. So it's a nice branding opportunity. It is fundamentally for our tenants, and that's who we serve. Also a very nice branding opportunity. Anyway, we bought this asset in August of 2022. We spent about 10% of building value on CapEx to make it much, much nicer. Very specifically, there's something called, it's a small category, and we think it should be a bigger one called ready to move in offices. So just, in Japan, you have to do your own fit out of the office, and you have to take the office back down to original state. So in other words, take out your fit out when you move out of an office. It's incredibly expensive to do both. And so as a result, there is a need that is largely unmet, that particularly for startups, to kind of pre-fit the offices, like put everything in. All the fixtures, the tables, the office layout, the glass barriers between the offices, as you can see in the pictures, and you just save a ton of money as a tenant by doing that. And so we've done this in multiple occasions. In this case, about 90% of this building has become ready to move in offices. It's been explosively successful. We've taken up rents 50%. It is nearly full and is going to be full very, very soon. So this is a very powerful offer, and it is an example of kind of the value add work that we do. As I say, very high efficiency, but you're meeting an unmet tenant need, which is how to get in and out offices without having to spend kind of, in certain cases, kind of multiple years of rent. I spoke to it earlier. Hotels are a stock earnings growth driver, and that will continue to be the case. We expect to beat this year's full year forecast. I'll turn to Ichigo Owners, which, as you know, is a high quality, and we talk a little bit on the next page also. It offers in prime locations, beautiful, brand new residential assets. The demand for this among tenants is very, very high. It's a very ongoing, very secure revenue stream, income stream. With inflation in Japan, Japanese investors and global investors are looking for access to a high grade, high value, a durable and growing revenue stream. And so this is a very popular asset category. As you can, as we've written on the first bullet point, the core offer is prime residential assets tailored to tenant investor needs. There's some volatility in this business, but as you can see, the line is going up and it will keep on going up. We had a little bit of fall off for forecasting this year relative to last year, in part because there is significant rental income on these assets before we sell them. This is a high turnover business. We generally buy the assets, lease them up in under a year. And so these are very high quality assets. We actually spend time with the developer speccing out what we want, and we have this huge database and think we're very advantaged in understanding what tenant needs are. And so the lease up activity is very fast. You get it to 90% occupancy, then you sell it. But last year we actually pushed back the sales towards the end of the year. So about of the 5.4 billion that you see for last year, about 0.5 of that is just kind of unusually long holding period during the year. So kind of on a more kind of ongoing basis would have been 4.9. This year it says 4.5. We'll probably beat that. So anyway, we'll look fairly similar to last year. But going forward, this will continue to grow. And again, we started this business 7 years ago. It started at 0.1. We're up, 50-fold over that, what has been in a 7-year period. And we expect to grow this fairly substantially. This is our fifth Ichigo Residence token. Again, forgive me if I repeat the things I said before, but that's hopefully better than not saying things that are completely different from what I said before. This is a market which is securitized real estate, digital real estate on the blockchain. It is real and valuable. It's not a belief in golden god like crypto. The dividend yield on this is about 4% for really nice assets, brand new. This is coming out of owners, right? So these are the assets that we do. Prime, really nice, brand new assets, residential in Tokyo. The demand for this product is overwhelming. We'll do our fifth one. So we've announced this, our fifth one to date. Our second this year. We expect to have 2 more that come later in this year. Or alternatively, if those don't happen, we'll have alternative sources of demand for these. But this is a very productive kind of real estate offering and a very powerful asset management investment for investors. So it continues to grow quite well. This is what the growth curve looks on this. We expect to have 60 billion of assets in Ichigo Residence tokens this year. We think that pushes up to 100 next year. And then, this is what overall growth in our asset management business looks like. As you can see, recent growth has been driven by residence tokens and meaning kind of we've done entirely residential assets into these tokens. We think this market expands outside of that to hotels and other assets, but for the moment, the tokens we've done have entirely been residential. And so the growth that has happened in this has been primarily in our asset management business, has been in the tokens and the private REIT. Next year, we think we do another 40 billion or so of tokens, probably another 20 billion in the private REIT. We expect to be active in the public REIT in part. The hotel REIT, the share price performance is very strong on, it's super powerful economics. So the economics that we're driving out of our hotel business are not only for the shareholders of this company, 2337, Ichigo Inc., but Ichigo Hotel REIT 3463 is a security code, is doing very, very well. So there's an ongoing opportunity there. And again, we add value. We do not just buy assets and leave them alone. So we are very active and very productive in growing value within our own balance sheet for our shareholders and also within Ichigo Hotel REIT. So we expect to do, if we did for another 40 billion in that, in the public REITs next year, this year, we push up our AUM to 400 billion. Next year would be up to 500 billion. Clean energy, continue to want to grow this business. And we see the kind of immediate opportunities in green biomass and non-FIT solar power. We announced the buyback, as I said earlier, 6 billion. As you can see, we're upping the tempo of our buybacks. That reflects both super strong cash flows, a stock price, which we don't think reflects fully the extraordinary operating environment and the powerful business model that we're in. We've also been pushing up our dividend more recently. I mean, this is an ongoing debate internally. Do we bump the dividend? Do we buy back our shares? Do we invest for growth? Well, the answer is we can do all three. So particularly our domestic investors who have been good and loyal, like the high dividends. So we have been raising our dividend. We expect to continue to do so. The current dividend yield is about a little bit under 3%. So that's a very nice yield. Let's not forget in Japan, despite rates, the BOJ now no longer being in zero interest rates, it's at 0.25% interest rate, so 25 basis points. So rates are really, really low. The long bond trades below 1%, so you can earn a 3% dividend yield on our shares. That actually works very well for a lot of investors. We have, as you know, we are a top sponsor of the J League. It's an extraordinary branding opportunity for us. It has driven a lot of understanding and recognition for Ichigo, and we have a shareholder program where we distribute the tickets from the J League games to all of our shareholders in all of the entities that we manage. We believe in working to protect the global environment. Climate change is real, and as I pointed out earlier, we've completed the 100% switch to renewable energy this year. Far more fundamental than that is we are climate positive. We do through all of our clean energy, and so this is solar and wind power production activity. We have very substantial CO2 reduction. In fact, it's over 4 times higher than our CO2 emissions. And that's the breakdown of how, over time, as you see, we've both grown. The green bars show the growth in our clean energy production and how it reduces CO2 emissions, and you can see that the shrinking kind of light blue bar, which is the decrease in our CO2 emissions as a result of our cut over to renewable power. So I'm now happy to take questions from anybody. Greg.
Yes, hi Scott, this is Greg at Point72. Can you hear me?
Yes, I can. Thank you so much.
Great. I have a few questions. Maybe I'll split them into 2 parts. But the first series, or the first 2 questions, would be token REIT or token real estate issuance. I would say that's obviously going very well. Can you remind us a little bit what kind of fees you guys get on those on an annual basis, and also what's kind of implied cap rate you managed to sell those residential assets at? Would be my first question. And then the second question is regarding the borrow cost. As we look at your presentation material, the average maturity has gone up, so I assume you've borrowed more at the long end. Can you give us a sense for what kind of interest rate you're borrowing at for the 10-year or so maturity that you've borrowed at? Thank you.
Great, got it. So the fees on the tokens is, I mean, this kind of can change a little bit, but generally speaking, it looks like something like a 1% upfront and a 50 basis points per year over time. The cap rates look like kind of the low 3s because these are super high quality, brand new Tokyo Prime assets. And Greg, your question about borrowing costs is our most recent borrowing costs, or?
Yes, because half over half you've extended the duration of the borrowings. So incremental borrowings, longer duration, higher cost, I assume. But like how much kind of higher cost?
Yeah. Thank you very much. Why don't we show the page from the presentation that shows our borrowing costs? Thank you, Greg. That's, as always, a very sophisticated question. So page 14, you can see that our borrowing costs at 1.13% right now. Kind of actually, there's hedging activity in there. All in, we're borrowing right now, and the most recent is borrowing. It looks like 1.25%.
Okay, so that's again, very low.
These are not material moves, not at all. Our borrowing costs have gone up a tiny bit. Replacement costs has gone through the roof. It is an extraordinary time, the best time in my career in Japan to be a real estate investor.
Well, certainly for the token, high 2%, low 3. That's pretty good for the residential there. Yes.
Yeah. Yes.
I have two more questions. Should I go ahead or back into the queue?
No, go for it. Go for it.
So yeah, 2 quick questions. First one, please an update on the Trapedia building, the vacancy progress. And second, your opinion on the Raysum transaction. when this was announced, obviously, I was immediately thinking about you guys, and so wondering if you have any view on that. Thank you.
So trade PI is going very well. I mean, as you know, that went from a great asset to a problem asset during COVID, and we just keep on punching away and doing what we do. So at this point, we've got occupancy up to 76%. It's heading to kind of, we think it may actually, it's certainly going to go to 85. We think could well go higher than that during this year. So this asset's very much on track. We've done a bunch of work to reposition it. We've done things similar to what we did in the Ichigo Meguro building, where we've made it far more attractive. We've had amenities like cafes and things like that. It's actually kind of, in a sense, a destination building for a lot of startups and along Tokyo Bay. The views of Tokyo Bay are fantastic. This was originally Sojitsu's headquarter building, so it's a great building. We're actually going to take one floor and do a ready to move in office there for some startups, because the demand is so high. So this asset is going very well, and we expect that we will do a sale of this over the next couple of years. Now that it's kind of going to be fully stabilized as a really nice asset. And then on recent, I mean, anytime you see a company bought at a 93% premium, that's nice. So it did take out one of our peers. It does show very substantially value, and that kind of is available in this space. It probably also speaks to the fact that Hewlett, which is a pretty smart, as you know, the buyer was a big Japanese real estate company, which is a very smart real estate company and a good buyer, saw that kind of value. And so it does speak to we think, pretty directly, since Racem is a peer of ours, as being kind of each shares being undervalued.
Did it have something to do with the size of the buyback?
No. Meaning the two are linked. If shares are deeply undervalued, you'll see companies like Hewlett being opportunistic and using their balance sheet and their ability to fund well to acquire a cheap peer. And in our case, we think our shares are deeply undervalued. And by the way, this buyback is not one-off. As you know, we have been buyers of our own shares and retired quite a bit of it, and we'll continue to do so. And of course, in the long run, we expect to drive our shares to where we think full value should be. So we're by no means are we satisfied with the current share price, but it does create an opportunity to buy in the shares at a very good level.
Okay, great. Thanks much, Scott.
All right, thank you so much. Okay, thank you very much, everybody. We're really grateful for your time, and I will keep working away to deliver the strong returns you deserve. Have a good day.